What's going on, everyone? Happy Friday. I hope everyone's having a good day. We're going to be talking about a couple of different trades today. One that we're going to have to talk about, everyone's looking at it, is what's going on around Pfizer. So we're probably going to start off the stream taking a look in depth at what's going on around Pfizer. But another trade that I want to break down for you is what I'm seeing around Disney right now. So Disney is up, I believe, 10% today. It's like a huge move for the company today. Let's have a look. Yeah, Disney's up 10.62%. Like huge move for the company. Something that we haven't seen in quite a while for the company. It's obviously been on an uptrend recently, but there's probably going to be a good trade here that we can use, taking advantage of this call skew. So if you have a bullish view on Disney, I'm going to be showing you how in the option space, you can structure out a trade to take advantage of what the market's currently saying to structure a really good trade, really good risk reward, bullish view on Disney. Besides that, we have no earnings trades today that we're going to take a look at. And I'm going to explain to you why even if there was an earnings trade after hours today, we wouldn't be taking it. And it has to do with how we actually structure out an earnings trade and what we're trying to express a view on. Remember, I talked about it yesterday. We talked about the three circles of volatility, right? Market volatility, non-event volatility, and event volatility. And if we're trying to isolate the event volatility, we really want to minimize our exposures to the other ones. So just before I get started here, if you don't mind, guys, Kyle and Ned, talking to you specifically, make sure hit a like on this video. The YouTube algo gods, we want them to be kind to predicting alpha, and that obviously helps out. So it'd mean a lot. Besides that, if you guys have any trades that you want me to take a look at, drop them in the chat box and we can take a quick look over them. Be happy to do so. Ned, I heard that your relative value trade's going really well with Jordan. Super cool. But besides that, let's get chatting about Pfizer. So if I pull up Pfizer here, first thing we want to talk about is there was obviously a lot of hype around the news that was going to be coming out yesterday after hours for Pfizer. They were in front of the U.S. government looking to see if they were going to get their emergency approval for the COVID-19 vaccine. There's been a lot of hype around it, right? The success rate for preventing COVID is up to 95% for the vaccine. I'm pretty sure the number of side effects that have come out so far, like the issues people are having taking the vaccine, has been more or less minimal. So it's looking really good. It's looking like the Pfizer vaccine is something that is pretty exciting. But the news came out, they got the approval, and the stock actually dropped. And this kind of comes back to what we were talking about yesterday, where we were saying it's not just about what we think is going to happen. We have to always remember this, guys. What we think is going to happen is just one piece of the puzzle. We need to compare what we think is going to happen to what the market is implying to happen. We are looking at the stock today and looking at everything happening in the future and coming to our opinion about what we think will happen. And the market is doing the same thing. And we have to remember that the market is pretty damn efficient. It's not like the market's going to be out here saying, oh, there's no chance that Pfizer is getting this approval and not pricing it in at all, meaning that if they get this approval, it shoots through the roof. The market's also looking at this going, well, they have a good chance here, right? 95%, the news has been mostly positive. Everyone's pretty bullish on this thing. Why would the market not be pricing in some sort of move? Where you would find a trade is if you disagree with what the market is implying. So there's a couple pieces to this puzzle. One, we need to be able to see what the market is saying, right? We need to be able to take a look and go, what is the market's view? Where's the market saying the risk is? Is the market saying there's risk of a move to the upside? Has the stock price been, rapidly increasing as this news has come out? How certain are we that they were going to get this approval? All of these things we take into account to determine what the market's view is. And then we have our own research, everything we look at on our side to come up with our own view. And then if there's disagreement, now we can start to look for a trade. So yesterday, this is more or less what we were talking about. I didn't give an opinion per se because, and I still have this same view, I don't know what the hell's going to happen. Right? I'm not a specialist in vaccines. I haven't done the due diligence to say this is over or undervalued or what's going to happen to the stock if They get this approval, right? I don't know how much money they're going to make off this. I do know that Pfizer has over 30 vaccines and medicines that they provide in this, right now on their book, and they all generate huge revenue, right? Pfizer's not like, it's not like a startup that came up with the vaccine where this is going to, their revenue is going to go from 1 million to 5 billion. It's like they have hundreds of billions of dollars in revenue, and how's this going to impact it, right? We also don't know how they're going to be accepted globally, right? We have an idea of the acceptance rate for Pfizer in North America, but sort of like what happened to Zoom back in the day. You remember when news came out that Zoom was their data was going through China, and they started to get banned in the federal government in the US, for example. Well, what happened there was that happened, but then they started to get bans in different countries around the world, and that really impacted the share price. So how this will play out on a global scale could have a big impact on the stock price as well, right? And that would be a huge driver of revenue for them. So first thing to note, which is super interesting, is stock price dropped, but that's not the only thing that dropped. Vol dropped by 12%. Okay, if Vol was being priced at 100, right? Okay, so Vol was being priced at around 60. Vol dropped by 12%. So about 7 points melted off. And that's pretty sizable, right? And if we come down here to the IV spot correlation, we sort of see that, right? And if we zoom in actually here on the price chart and we zoom in on the implied volatility, we can see that it sort of makes sense, right? As the share price was increasing, the implied volatility, yes, Ned, that's the past 30 days. As the share price increased, the implied volatility increased. Now, what can we take from this? The first thing we can take is that the market has been pricing the risk to the upside, which is not what we typically see, right? If we look here, we can see that a decrease in price is correlated with an increase in implied volatility, which is usually what we see for single name equities of this size, right? The risk of a big company, right? Like where's the risk for Apple? Is the risk that Apple goes up by 20%, or is the risk really that Apple goes down by 20%? Well, the risk is probably to the downside for a company of this size, right? A well-established company. But the market was pricing it to the upside because, of this approval of the vaccine, of all this stuff. And when we see this small tick down in price after the news came out, IV starts to melt. So what can we do here, right? What can we do here? Well, the first thing I'm going to say, same thing I said yesterday, is especially for this stock, my word is not fact. I don't really have a super strong opinion here, but there's probably something worth exploring. How much is the market really pricing in here, right? We get great news and the stock price drops. That indicates to me that the market already had an opinion on this thing, that it was going to be approved. That's why we didn't get the pop that everyone was expecting. We're still seeing some near-dated call skew. So if you do have a little bit of a bullish view, you can probably structure like a vertical or a 132 or something of that nature here to take advantage of it. And we can see that if we look at the term structure, that the market is still holding the view that near-dated is where we have that big risk, right? It's pricing upside risk. And if we look at so we see that here because basically what we're looking at in this skew analysis is on the y-axis, we have the level of IV. Each of these three lines is a different expiration. So let's say we look at 10 DTE. On the bottom, we have the deltas. So on this side, we can basically say these are the way out of the money calls, way out of the money puts, at the money. And we can see that as we go to the call side, the IV increases. And on the put side, it's a little bit down with a small tick up way, way out of the money. So market is saying risk is to the upside. Okay, right? High IV on the call side, risk is to the upside. If there's going to be a big move, it's going to be up. And they're also saying, if we take a look at the volatility, the implied vol, right? This is the term structure. So on the bottom, we have the different expirations. And on the y-axis, we have the different implied volatility levels for each of those expirations. We can see that the highest implied volatility is now, right? The 10 DTE. 20 DTE, it starts to melt off. It melts off 10 points. And then we trickle down, all the way back to, I believe, what is their average non-event volatility a year out of 33. So market's still pricing in something to happen very soon, but we already kind of have the news. So what we could ask ourselves is, what else can we expect in the next 10 days? What is our certainty around this stock? What news is going to come out that's going to cause a surprise in the next 10 days? If we think that the cards are on the table, well, there might be an opportunity here to be short some volatility, because what is going to cause this thing to move? Right? We can really start to ask ourselves those questions. We can see that the level of implied volatility is still super high, right? Looking at our vol cone here, right? This is the range that it's usually within. It's below this line 75% of the time. This is the third quantile for volatility level across different strikes. You can see that we're way up. We still have that tick to the upside. So we could be structuring out a short dated trade here. If we think the stock is going to stay rather stationary in the next few days, well, we could be potentially shorting some vol here to take advantage of it. Now, if there's something you think that will happen, some trickle effect of this news that came out, or a new press conference that'll be happening, that maybe the market isn't really, is understating, right? If that's maybe your view, we have in Predicting Alpha, there's a few pharmacists, for example, who have a pretty bullish view on some of these vaccine companies. It feels weird calling Pfizer just like one of the vaccine companies because it's so much bigger than the others. But if you hold a different view, well, I would love to hear about it, first of all. So if there's anyone in here who has a different view, thinks that there's something that might be happening around the company in the next 10 days, 10 business days, I would love to hear it and love to discuss it. Let's see. If we take a look at the skew here, right, this is going to be really interesting, actually. Let's expand this. So when the skew is really high, it implies that the puts have a higher implied volatility than the calls, and the risk is to the downside. And just like I was saying before, for a company of this size, we expect it to be up here most of the time. It makes sense that, think about this. If you're a pension fund, Pfizer might be something you hold. If you're a big hedge fund, this might be a part of your book. And if you're long equity, remember, most of the world is long equity. Well, you're going to be buying the puts to hedge, going into events in volatile times. It's basically buying some insurance for your book. And when you have such a sizable book and your game is making money off of fees, your goal is just to not lose money. So you're willing to overpay a little for that insurance. And that makes sense why we see put skew. But as we move forward and as this vaccine news came out, all of this type of stuff, look at this. Let's zoom in on 1 month. Boom. Down below the line, we now have skew extremely to the call side, more than we pretty much ever see, more than we have seen in the last 2 years for Pfizer. So, right, the market is extremely bullish on this thing, saying the risk is that big pop. If we disagree, we could structure something out to express that view. Now, today's live, we're going to also be talking a little bit more about skew. If you're not familiar with the topic of skew, feel free to shoot me an email or ask a question here. More than happy to break it down with you. We're going to be taking a look at Disney. Okay. Let's get rid of this. So we have our scanner here. That's what I was looking that up just to show you guys the change in IV on Pfizer. But look at this. Disney up 10.62%. Implied volatility for the 30 days is at 33%. And we're forecasting it to be a little bit lower. But given the huge move here, I wouldn't be just taking a short volatility play here. And I'm going to explain why using this whiteboard here. So one, we need to, as option traders, we need to really understand our product. And the big thing to know about options, first and foremost, is that they're volatility products. We are not just, if we buy a call, what do we have a view on, right? We have a call. Let's say it's a 100 strike call. We pay $5 for it, let's say, and it expires in, let's say, 30 days. Well, what do we really have here? So obviously we have a directional view, but we also have a volatility view. Hey, stop it, Ned. I'm fine with the mouse, right? Come on, you've seen how Jordan is with it. This is a relative value play, all right? Relative to Jordan, you should be bullish on my mouse skills, all right? Because the reason we have a volatility view as well is because we are expecting a certain size move in a certain amount of time. So for example, let's say 30 days passes and the stock is now at $103. Well, we were right on direction. The stock did rally, but we paid $5 for that call option, meaning we are actually still down $2. And that's because we didn't have the correct view on the amount or size or time frame that this move would happen within. So we need to understand volatility. And when we are looking at Disney, the factor that we want to take into consideration is that volatility clusters. Is that better, Ned? So what do I mean by this? Well, if we were to graph IV over time, right? So we have time down here and we have IV here. Well, how would volatility look? We might see something like this. Right? So what are we seeing here? Well, we're seeing that when volatility spikes, it tends to stay for a while, right? When IV goes up, it tends to stay high for a while. Or not IV, but just volatility. It's not IV. This is realized volatility. And when volatility comes back down eventually, it tends to stay down for a while. This is one of the characteristics of volatility. So what we've seen right now in Disney is that pop. Volatility shot up. It moved 10%. Guys, it's a big company. I can't believe it. It's such a huge move. I haven't done the research to understand why that move happened yet. If anyone has done their research on Disney and knows why, please drop it in the comments. I'd love to know. So right now we could be like here. And we could see, volatility continue to be high for some time, right? We might see another big move tomorrow. So what I would be looking for before I take any sort of short vol play on Disney is I would want two things to happen. I would want RV to go down, and I would want IV to either maintain or go up, right? So if we came in tomorrow or on Monday, let's say, and the move was back down to its regular moves, let's say 0.5%, 1%, whatever it's moving regularly these days, and volatility was still inflated, well, now we have a trade. Right now, I might be looking at this and going, okay, it looks like volatility's mean reverting back to what we normally see. Market's still pricing it in up here. Maybe we can take a trade. But that doesn't mean there's no trade to be taken right now. Right? There's still potentially a trade on the table for Disney if you have a bullish view. Okay? And what we're going to look at to determine this is a couple of different factors. So let's take off the maximum here. We're going to look at the vol cone. So we can see that for the near dated options, right, we have pretty much the highest we've seen in a while for Disney, right? The implied volatility is pretty damn high right now, right? We're looking at 37 vol for the 10 DTE, 10 business day DTE options. So volatility is high. So we can maybe take advantage of that. That's one factor. The next thing we want to look at is this skew here. Right? We can do a little bit of a skew analysis. And we see that for the near dated options, we have huge call skew, right? The difference between at the money and out of the money for the calls is almost 10 vol points. So what I'm going to show you now is a trade that you could structure out where if you have a bullish view on Disney, you can structure out an extremely good risk to reward trade. So Ned's saying here that it seems the news is some changes to its streaming services, new episodes, series, etc. That's what we got on the news and sentiment. Let's take a look quick before we move forward. It's always good to understand what's going on, right? Let's have a look. Let's see. Disney targets 100 new titles per year on Disney Plus, raises guidance, subscribers. Wow. Okay, so it totally makes sense why this thing popped, right? Guidance is up. Guidance is a huge driver of today's value. Remember, market's looking forward too. Company comes out, raises their guidance. Our view of the future and the market's view of the future should change to reflect that. So maybe that's what we're seeing here. And if that happens, right, this is actually a good sign that when we see this volatility, the actual realized volatility taper off, if we still see a high level of implied volatility in the market, let's say the retail punters are coming in, buying up the calls, well, maybe we want to be selling them to them, right? We can take advantage of that. Eric's asking about the implied volatility move shown in the terminal. Is that predicting the value of the stock price by percent or some other definition? Eric, just to clarify, are you talking about this? Are you talking about implied vol 30 day? Are you talking about PA forecast 30 day or 1 day implied move? If you can clarify that, I'll be able to better answer your question. So I'm going to get back to your question there, Eric, when you give me that little bit of information. But what we're going to do right now is show you a trade you can structure out on Disney to express a bullish view. The first thing we're going to do, though, is I'm going to show you what view we're expressing here. So let's say that, let's think of the best way to draw this. Let's say that here is Disney's price today. All right, this is price and time, let's say. And you think that, I'm going to be looking at the December 18th. So let's say this is December 18th here. Well, let's say I buy a call. What am I really buying here? Well, I am buying the potential that Disney can go up into infinity, right? But what if I have a view that Disney is not necessarily going to go to infinity, but we could see it maybe move to here, right? I don't think it's going to go to the moon, but I think it's going to continue to trend upwards. Well, we can take advantage of the high implied volatility and the call skew to structure a trade that allows us to have an extremely high risk reward if we are correct on this. So let's open up Thinkorswim. And here I am on the Disney chain. The trade that we are going to be looking at structuring out is a 132 fly, or as we like to call it, the PA fly. Right? We're taking it. It's ours now. Okay, it's not an unbalanced fly anymore, guys. It's a predicting alpha fly. Anyone asks you about this trade? It's a PA fly. So what we're going to be doing is selling some of those. All right, Ned, 132 on Disney. Hit it. What we're going to be taking advantage of here is those extremely expensive out of the money calls. We're going to be selling those and structuring out a trade that gives us that good risk reward a little bit to the upside, right? We're not trying to get that exposure to the 1,000% gainers, right? We're selling off all that and we're going to get something really good in the middle. So let's take a look at what we would do here. I'll show you exactly how we structure it out. So open up the December 18th chain and I'm going to come to at the money. Yeah, I'm on Disney. All right, perfect. So stock is trading at 172. So let's say we go to 170 here. And we're trading on the call side. But the first thing I want to do is I want to price out how much straddle is going for. And you'll see why in exactly 1 second here. So straddle is going for, we'll call it $7.50. Am I going to be able to do that? Let's see. 170 down by $7. Okay. $7.50 right there. And then we'll call it, let's have a 750. 375. Okay, so we're gonna have a little trouble structuring that out. So let's say we go 10. What if we do 10? All right, 10, 10. Or to the upside, 10, 10. Okay, yeah, we should be good. So we're gonna go 10 wide here. So here's how we're gonna do it. 170. So we're gonna go here. We're gonna buy an unbalanced butterfly. We're gonna put this at 170, right? So our first strike is at 170. And then we're gonna go that 10 up. Okay, so we're gonna go to 180 here. And then for the last one, right? So we're gonna buy 1 or 10, right? Right now it's at 10, but we're gonna say buy 10 of the 170 calls. We're gonna sell 30 of the 180 calls. And then to hedge, we're gonna buy 20 of the 185s. So the way that I've structured this is at the money, $10 up, or one standard deviation up, a little bit over that for this sake of this example, and then another half standard deviation up to hedge. And that's how we're going to structure this out. So let's go ahead and analyze this and see what we get. Take a look at this trade. So, right, Disney is trading at 170. Right, our expiration is 6 days from now. If Disney trends up to about 179 by expiration, we are going to make on this position a little over about $7,500. Tyro, what's up, man? It's been a long time. How have you been? We are going to make a little over $7,000, which, everyone, that sounds great. But what we really, really find interesting here is what we're making relative to our risk. So let's say we're completely wrong and the stock goes down. To our risk on making that $7,500 is just a little over $2,000. We're getting just about a 4-to-1, 5-to-1 risk to reward trade here for expressing that bullish view on Disney, right? Let's think about that relative to, let's say, just buying an at the money call. If we come back here and we just buy this call, well, we're risking 5K, right? And if we go up to that 179 mark, we're only making 5K. So let's say our view is that it's going to land somewhere around 180. Well, if we just buy the call, we're getting 1-to-1 risk reward. See, this is the power of knowing your product and being able to see beyond just the price chart, having access to that good information, right? This is why people buy a Bloomberg. This is why people buy a Predicting Alpha terminal. It's because when you can access information like that, you can structure out a trade. You go from this payoff to finding opportunities where you can have this payoff. Right? We gave up the exposure to the $200 move. Sure. But for the view that we wanted to express, we're in a much better spot. Right? And, for the purposes of this live, I stretched it out a little bit. But, if you actually, when I was looking at it this morning before Disney moved a little bit more, I was getting 9-to-1, 10-to-1. Right? So by taking advantage of these kind of structures, I've seen 20-to-1. Right? And the cool thing about a 20-to-1 trade is you only need to be right 5% of the time for it to be positive EV, right? To have that positive expected value for your trade. So this is the type of stuff that we want to be taking a look at. Ned, Jekka, what do you guys think? Steve, are you guys going to take a trade on Disney here? Or is this not saucy enough for you? Let me know. Hey, thanks a lot, Tyro. We just started up the live stream again 2 days ago. Take a look at this, Tyro. We built out our new terminal. So we've completely revamped the Predicting Alpha terminal. It's got everything you could possibly imagine. We have built a Bloomberg for the average person, right? Priced at a fraction of what professional traders are paying for data like this. Right, so we have all of our news, right? Global dashboard here. We can take a look at what indexes are moving right now, right? GLD is the biggest mover in terms of dollars right now. SPY's down a bit. Qs are down a bit. If we look at the implied vol side, right? So over here we have dollar change, and here we have the IV change, right? And we can see that the biggest change in IV has been HYG, right? We have GLD price went up. Vol went down. Makes a lot of sense. We need time zone signs for our clocks. Ralph, are you talking about these clocks? Is that what you're talking about? Here, let me know. Let me know which clocks you're talking about here. Oh, Ralph, come on, man. Come on, man. You don't think this clock says New York on it? Come on, man. Of course it does. Yeah, man. Come on. That's why we bought them. We had to, we had to be a little cheesy with it. It's our trading room. So, last thing I wanted to chat about on this live is earnings trading. Okay, so I was doing my morning scan. There's no earnings trades today, but I want to chat about this because even if there were earnings trades today, I actually wouldn't be taking them. right? It's not very often that you'll see a company release after hours on Friday or before market on Monday. But what I'm going to explain to you now, and this will be a really cool volatility concept for a lot of you here. Why I don't take earnings trades over the weekend, right? And I think this will make a lot of sense to you. So let's open up the whiteboard again. Okay, so to understand this, we need to go over one concept first, which is, I call it the 3 circles of volatility. I'm not gonna write that out, it takes too long. There are 3 forms of volatility that impact any given stock. The first circle is called market volatility. So every single stock is within the market, right? We have, let's say Apple, Tesla, Pfizer, etc. Now, market volatility impacts all of these stocks. If the market goes down, the equity that you were holding, let's say, also goes down with the market. Now, beyond market volatility, let's say we were taking a look at just Apple. If we zoom in on that, we see another form of volatility, which I'm going to refer to as non-event volatility. This is the regular day-to-day movement of a stock, right? Apple's a good company. They have great products. Their cash flow situation's great. They're growing. They trend upwards. They even outperform the S&P a little bit. That 1% to 2% fluctuation in price on a day-to-day basis, that 0.5% it fluctuates, this is that non-event volatility. Now, within every company, beyond the non-event volatility, we have a whole bunch of events, right? Each year, we have 4 earnings events. We have product releases. There's so many different types of events that a company has. And each of these has its own form of volatility associated with it. So we're going to zoom in on one of them, which is what we're talking about, which is earnings event volatility. So this is the event volatility. Now, a very cool thing that I found out is event volatility can drive 30 to 70%, right? 30 to 70% of how much a stock is going to move in a given year. When we are trading earnings, we are focused on this form of volatility. We are trying to trade the event volatility, right? So if I come back to the earnings analyzer tab, for example, I don't know what's coming up soon, but let's say we're looking at Apple, right? What we have up here, for example, is the implied move, which is us trying to, and what we're doing is extracting the earnings implied move for the next event, right? We're saying, if we go back to the whiteboard here, what we're trying to do is say, if we strip away the market volatility, and if we strip away the non-event volatility, and we just take a look at the earnings volatility, what's left? What is the market saying for the next event or this event that we're looking at? How much of a move is the market implying here? Then we take that, we have a whole bunch of factors we look at, and we determine, are they overpricing or underpricing volatility going into this event? Are the options cheap or expensive based on what we think is going to happen around the event? Okay? So, now that we've gone over that, let's talk about why we don't trade it over the weekend. Well, let's imagine we have a timeline here, okay? And let's say today is Tuesday. Well, earnings events happen at 2 points in time. They either happen after market close or before market open. There are 2 points in time when the earnings events typically happen, right? I think some companies occasionally release in the middle of the day, and I'm like, what the hell are you doing? But this is when we usually see it. So what we like to do, remember, so the event happens between 4 p.m. on day 1, Eastern Standard, and 9:30 a.m. the next day, Eastern Standard. So what we do is we like to enter our trades here and exit our trades here to maximize our exposure to this time period and minimize our exposure to everything else. This is one way that we isolate that event volatility in our view. We have a view on what's going to happen around the event, but let's say it's, let's say there's an earnings happening on Tuesday after hours and it's 10 a.m. on Tuesday right now, and I enter the position now. Well, not only do I have that exposure to the earnings event, but I have exposure to all of this area, right? If I enter the position here, well, I have exposure to the market volatility here and the market volatility here. And that's not necessarily what I wanted for my view. So a lot of you probably can already see why I'm not trading over the weekend, right? What we have is this now. We have market volatility, right? So let's say this is after market close. Well, before market open is now all the way over here. And we have this is Friday after Friday close. We have Saturday, Sunday, Monday open. We now have the entire weekend. All right? This exposes us to more market volatility and non-event volatility than we want. Our view is now our view is not just, we only had the view on the event, but now our view is actually expressing an opinion on the event and what's going to happen over the weekend, which skews our data and actually takes away the edge that we have when trying to structure out an earnings trade. Do you guys have any questions about why, even if there was an earnings event today, I wouldn't be trading it? I'd be happy to break it down for you to go over it. But if not, that's more or less what I wanted to talk about on today's live. So we'll be wrapping up here. But before I do, if you have any particular stocks that you want me to take a look at, I'll be happy to pull it up for you, show you some data on it, maybe give you my opinion on volatility, if I think it's cheap or expensive, maybe what I would be doing with the limited knowledge I probably have about the stock that you're looking at. Would be happy to take a look at it for you. Yeah, earnings is one of the major strategies that Jordan and I trade in our book, by the way. Lots of edge there. It's pretty cool. Let's take a look at AMD for not my Ernie. And whose Ernie is it, man? Come on. Okay, AMD pretty flat today. Implied volatility at 49%. Given our ensemble of models, we're forecasting volatility to be at 45%. So can you give me a little information about what you're seeing happening around AMD right now? A couple things that I'm noticing in terms of sentiment, we'll start there, is that media coverage is a little bit lower than what we usually see. So if we go down here, articles published last week was just 21 compared to an average of 27 that are published about AMD. We can see that the buzz is about 75% and sector bullishness is about 67. So and new sentiment is about 88. So market's a little bit more bullish about AMD than it is about the rest of the semiconductor industry. We can see that most of the big funds that hold it, this is kind of interesting actually. What do you guys think about this? We're looking here at company ownership. Most of the big funds that hold it, right, the top 10 holders of it, have all actually reduced their size. Some by pretty sizable amounts, right? Vanguard Group offloaded a ton of shares just earlier this year. Retail sentiment, which we pull from social media, is 100%. So every retail trader is bullish on this thing right now. News is pretty bullish on it. So far today, as of about 10:30, we're seeing about 7% of the typical option volume being traded. So pretty well in line for what we'd normally see. There's no unusual option activity happening right now. If we come over here to the Vol Insights tab, well, do we have earnings coming up? Let's see. No, so earnings is done. Next earnings is over a month away, out in January. So we don't need to pay attention to that right now. We're not really pricing vol crazy different. There's a bit of a spread that we could take advantage of if we think that this thing's going to remain stationary. Little bit of edge there. But just like Pfizer, we're seeing huge near-dated call skew, which is very interesting. Not my Ernie. Do you have any idea why we might be seeing this right now? Right, we're seeing call skew. 6-point spread between, the Delta 50 and the Delta 25s. Once again, we could probably, if you have a bullish view on this, let's see what it would look like if we structured out a 132 on it. Right, 132s are what I like to trade if I have a directional view and I'm seeing some call skew in my favor. So we'll go over to AMD here and we'll take a little bit of a look. Let's see. So we're on the chain for AMD. We want to be trading the near dated because that's where we're seeing the call skew. And let's see, first of all, what the straddle's going for. Straddle's going for, let's call it $5. And at the money is, let's call it $92. So we're going to come over to the call side. We're going to buy an unbalanced butterfly and 92. So, okay, well, we have the first one at 91. That's fine. So we're going to go up $5. So to 96. And then we're going to go up another about $2.50. See if we can do that. 98.5. It's not trading. Okay, no problem. Let's see what we got here. We'll go with 99. Let's have a look at this trade. It's a little bit unbalanced. It's kind of annoying. Maybe I can see 5. So what if we change this to 97? We'll go 6 and we'll put this at 100. So let's take a look at this trade here, guys. So we have a max risk of, about $800 with a max payoff of about $5,000. Okay. So if we throw on this trade, we have a risk of $800 for, this trade here with a max payoff of a little over $5,000. Okay. That's a 5-to-1 risk to reward. And what we need to happen in order for us to be making money is the stock to rally a bit from, let's say, 91, if everything went perfectly, to about 97 in the next 6 days. And if that were to happen, if it were to what we call pin at $97, we would make a little over $5,000 on this position. So I hope that helps you, Ernie, gives you a little bit of insight into what's going on around the stock. We can look at the term structure. Let's take a look at the vol cone. If we take off the max and the min, I usually take off the max and the min right now because I want to know what it is at now relative to what it typically is historically. We had tons of vol in March, which is skewing the data at the extreme tails. So you want to, account for those outliers and say, okay, what can we really expect here? So, this is kind of interesting. We're actually seeing vol below where it usually is for the 10 DTEs. This is kind of interesting. No problem, Ernie. Eric, what are you, let me see what your question is here. There must be some people trading, holding over the weekend, especially institutional traders. What thought process would they have if there's unknown risk? Eric, do you mind, are you talking about earnings trading there? Just trying to clarify what your opinion is or what you're asking about. So we could actually potentially be buying some vol, right? So that 132 fly that I put on, it's really good for taking advantage of that call skew. And it's really good if you have that directional view. But if you don't have that opinion, we could actually maybe be buying some volatility here, right? Buying a bit of vol near dated. And if we get a pop, we could be making some money. But, I'm not super confident in this, actually. I'm going to retract what I said. I don't think I'd be taking a trade on that. But we could maybe go a little bit further out and do it, right? If we went, maybe 30 days out where we have a little bit more exposure to the level of implied volatility, well, now we could maybe structure a trade trying to see a bit of mean reversion here. So there's a couple of ideas that we could take advantage of for AMD. Anyone else have a trade that they want me to break down before we wrap up the live here? This has been an awesome little 45-minute session. Quick reminder, everyone, predicting alpha terminal costs $80 a month. And with that comes access to our community, direct one-on-one support from Jordan and I. You can actually book a one-on-one session with me every single week to go over anything you want, your portfolio, a trade you're looking at, in-depth concept breakdowns. We have an entire suite of education. You actually get included with the terminal, literally 150 hours of education procured by Jordan and myself. Obviously, the number one thing is buying access to this terminal. I hope that this session is showing you, like, having access to information like this. There's a reason people pay $25,000 for a Bloomberg. And a lot of these graphs and stuff are exactly what you find in a Bloomberg. The only other place you can find a volatility cone is Bloomberg, right? I actually think our earnings information is better. And you get access to your news and sentiment, like what we were going over for AMD, how we were able to see what the retail and news sentiment was. We could see, who's holding it, what's the change in shares, what's the buzz around this company right now. There's just so much information that helps us craft better views and express that view better in the market. And that means that we have more control over how our portfolio performs. We want to remove as much faith as possible and push in as much evidence as possible into our decision making, because that's what it actually takes to win in this game. If I can leave you with one piece of advice, general trading advice, at the end of this live, it would be that trading is a competition, not a test. Okay? Always remember that. Trading is a competition. When you place a trade, there is somebody on the other side of your trade. And when you make $1, they lose $1. And when you lose $1, they make $1. So really ask yourself, are you deserving of taking their dollar? If the answer is yes, it'll reflect in your P&L. So with that being said, quick reminder, we do these lives every single day, Monday to Friday, 10:30 a.m. Eastern Standard Time. They're usually between a half hour and an hour session, depending on the questions we get, the trades you want me to look at, the trades that I'm looking at. As things evolve throughout the day, obviously more stuff comes up, but can't spend my whole day on YouTube. We have a book to manage and a business to build here. So I hope you enjoyed it. If you got some value out of this live, please help us out. Drop a subscribe, leave a like on this. The YouTube algo gods have not been super kind to us recently. I think that we're giving some great value here, and there's a lot of traders out there who need to hear this type of stuff to really find their way in the market. So I would appreciate any of the support you guys can give, and I look forward to seeing you on Monday. I hope everyone has a great weekend. Take it easy.